Welcome to 20 Minutes of Clarity.
I'm your host, Jason Noble. And as always, I'm joined by my co-host, Andy the Man Merchant. Andy and I are having an important topic that we want to make sure we're discussing today around wealth and lifestyle protection, is around managing taxes, and then also distributions during market volatility. So grab a pen and paper and let's get ready. We're going to get rolling. Andy, let's kick us off, man. So we're talking about taxes. You got to help me understand, and the listeners, why is understanding how taxes on distributions or taxes work when it comes to wealth and lifestyle protection?
Well, right off the bat, the key theme we're in, the series we're in, is wealth and lifestyle protection. So I always tell clients, if you're going to go make $100,000 and you don't get to keep a full 100, you lost some wealth, right? And the question is who are you losing it to? You can lose it to market volatility. That's where we're going to talk about distributions a little bit, and the timing of distributions and the importance of having kind of a sustainable withdrawal rate. So that's going to be a topic we're going to talk about today. But then on the tax side of things, as you just asked, is that if I sell an asset at the improper time, if I'm accumulating assets, I sell something before 365 days and I'm in a high tax bracket, I could lose, up to 40%. Not kind of the ideal gain to give 40% to the government and lose wealth. If you own real estate and you've taken advantage of some recapture benefits and some things along the way, those are, guess what, taxed at a higher rate. And so it's really about optimizing and understanding your assets so that you can minimize or be proactive when it comes to tax planning and retaining some of that wealth. You're going to have to give up something. The only 100% free lunch is a Roth or some other strategy that allows growth and distributions tax free. But here we're talking about protecting your wealth from basically optimizing your tax planning, some strategies that go into that. And then obviously making sure that those that are in distribution phase aren't losing wealth due to the inability to recapture those gains. So let's start with that, Jason. Are you good with starting with some of the retirement planning thoughts?
Yeah, and I like to share stories as we go through this as well, because I really feel like this articulates the point. And one of the things that came to my mind was a business owner that I was meeting with. They were working with another financial advisor, and they just came in for just a second opinion. And with their income that they were making through the business, they were just being an LLC. It was a pass-through entity, and they had to pay taxes on the self-employment tax, and then they had to pay ordinary income on top of that. It was a whole hot mess. We created an LLC subchapter S, of course, with their lawyers and their accountants, okay? But it was for me to understand how all this works, being a financial professional, and working with them as the quarterback going, hey, have you considered these things? When your accountant has discussed this, what did they suggest? When your financial advisor suggested this, what did they discuss? And when I asked those questions, like when you have already had these conversations, what happened? He goes, we haven't had these conversations, and I'm tired of being raked over the coals by the government. Mm-hmm. We're able to offset their taxes by just restructuring their business the better way, the appropriate way, saving about $38,000 in taxes. And so like when I'm watching like political debates and things of that nature, and I'm watching the talking heads on TV. Now, why do I watch it? It's because my clients do. I don't really want to, but I also like to know what my clients are watching. And they're going like, oh, look at these rich not paying their fair share in taxes and things of that nature. Okay, well, maybe that's something that can be done. But no, they work with financial professionals that are going, I understand how the tax code law works. Let's work with your accountant. Let's work with your business attorney. And let's structure this a certain way so you can keep money in your pocket. And I'm going to say here, anyone that's watching and listening right now, do you not agree with that? Like, do you really want to give just more money to the government because you feel like they're better stewards of your finances than yourself? Because if so, this is not your podcast. Go turn on to something else. Andy, I'm not trying to turn people away from us. It's just going like, every single person I serve, right? Every single one wants to keep as much as they can for their family, for themselves, and to pass on to another generation. I have no one I work with that says, you know what, Jason, I think I'm not paying enough in taxes. What can I do to increase my tax liability? Because I would rather just die a pauper, right? No. No, they want to make sure they keep as much as they can. And so this is why we're saying wealth and lifestyle protection incorporates taxes. Like this distribution strategy I just did with yesterday, if we didn't make any changes, 31% of all the withdrawals over the course of their retirement were going to go to Uncle Sam. 31%. They did not put 35 years into working for a company and having to deal with those nights and weekends that we all know about. I don't want to get into right now. To give 31% of their hard-earned money back to the government. By the time we were done that meeting, we looked at ways that we could offset it. We lowered it down to 14%. You think they left this office with a smile on their face, or do you think they were mad because they wanted to pay the 31 and I didn't allow them to?
Well, I think I'd just add to, I agree. You know, I don't think anybody that's listening, so nobody needs to tune off, right? Is nobody wants to pay taxes any more than they have or overpay, right? No, I think that's the key word. Nobody wants to overpay. We all agree that to live in a free country, to have the freedoms we have and the liberty we have, it costs something, but we just don't want to overpay. And I think that's the key word here. And I think if we're starting off this, right, if you're accumulating assets and you did what you just said, if you're a business owner, most of the business owners may not know the how or the why. They might know what they want to do, right? Oh, well, like S corp, filings. There's some concerns that, considerations that need to go into it, but there is not enough tax partners out there that are tax strategists and are proactively looking for you, right? I mean, if you're one of those people that's out there listening or viewing to us today and you're like, man, my tax partner has not called me proactively. The only thing they do is wait until like January and say, do you have your statements? And then they do your tax return. That's when you need to call us. We're not CPAs. We're not giving tax advice, but we understand the key components that go into saving you money as a business expert or a business owner through the strategies the tax code allows, right? We can help guide you through that. The other thing is if you're accumulating assets and you're in your kind of earning years, we don't want just to kind of just progressively go up the tax bracket. There are strategies that you can consider to make sure you're maintaining all of your eligible tax credits, right? Those phase out as well. Those are separate conversations. We don't air those kind of details on this podcast because they're so specific to people, right? But could be, Jason, I was with a business owner the other day or self-employed. He's like, I'm going to pay a lot of taxes. And I'm like, have you thought about doing a SEP contribution? And he's like, a what? Right? I get a lot of a what questions. And so our role, and this is why we created this podcast, this is why we created the Clear Picture Wealth Program, is to simplify those complex relationships, because we know every single day you're out there earning your income through your trade. This is our trade, right, Jason? So we really want to help people understand that we don't want you to lose wealth and assets, your overall wealth, because you said, I didn't know I could do that, right? That's what irks me so much, because we're here. Now, a lot of other advisors won't offer that service to you because why? They can't. But we've committed to our process and our plan, and that's our unique ad. This isn't a commercial for us. This is a kind of a public service announcement. So is hey, you know what? If you care about maintaining and optimizing and not overpaying your tax liability, you have to go to clearpicturefinancial.com. You have to click on the button and you have to give us a call. Here's the best part. If you do it now, it's free. We're going to waive the fee for anybody that's willing to go through the initial analysis. And then we're going to show you how you can make sure and have peace of mind that you're not overpaying. You can tell my passion in my voice here because I've seen so much wealth lost because of inefficiency on taxes. I'll pause because I'm a little fired up.
Andy, when you were saying, like, when we come across someone that says, I didn't know to do that because I didn't know, our hearts break, but also this is where we step up as the professionals to help educate and put them in a better path by giving them information so they can make better informed decisions. And one of our good friends, Bilal Little, who we met at Future Proof and we had on our podcast, A Clear Pictures Conversation, he shared this story, and I think it's really appropriate to this point of the conversation. He goes, I thought growing up that filet mignon was the best steak you could possibly ever get. And finally, I started our industry and I started growing in my career, and I made enough money where I'm like, I'm going to go in and I'm going to go to a great steakhouse and get filet mignon. And he goes, and I cut in that steak. It was amazing. It was the best cut of meat I've ever had. I just thought it was the best thing ever. And he goes, man, they were right. He goes, a couple months later, I'm meeting with one of my larger clients. and he brings his 12-year-old son with him, and we're at the same restaurant. And his 12-year-old son says, "Daddy, you okay if I order the Wagyu today?" And the dad is like, "No, no, no. We don't do that at business settings. We do that for like very special occasions, and that's when we're paying. No, son, like watch what Bilal orders, what I order, and then make your decision from there." So, like, okay, here's this 12-year-old that's being coached by a wonderful father, right? Number one, and number two, like, Bilal's sitting there and he goes like, "How did this kid know about Wagyu?" Because he never heard that term before. And so he goes home after the dinner and he starts Googling what is Wagyu. And he's like, "Wow, okay, this is a world that I've never heard of before. I didn't know about this." He goes, "Next time I had the opportunity, I paid the money, and boy, it hurt, but I paid and I tried it." And he goes, "Now I had the best cut of meat that I've ever had in my entire life." And the takeaway from that story and the takeaway from Andy's story is you could have good foundation to your understanding and knowledge. However, what is out there that you don't know about that could potentially hurt you and or benefit you? And this is where clear picture analysis and our wealth program come into play, because we have access to that information. And very few times, if I've ever got stumped, and the stumps Andy, we have resources around us to get access to that information instantaneously so we can help our clients make better informed decisions.
Well, and even adding that, Jason,
you and I are just kicking it back and forth,
I know.
buddy.
This is a fun one, but on top of that, it's like just not only just having access to the information, right, that you said, but having the confidence in the professional that is helping you, or having your own confidence. Like you can GPT and AI search things today left and right on everything, and it's going to give you an answer. But do you have the confidence that it's the right answer and how to implement it? I mean, I'm going to tell this story, and then I think we should shift over into like some distribution considerations and the impact of lost wealth without having that plan. But I was speaking, Jason, to one of our other advisors the other day. We work a lot with clients that are maybe doing property and unique asset transactions, and she was like, "Hey, I'm super excited. Client called me up. They're going to be selling some land. We got to help them kind of plan." And she's like, "I'm going to go ahead and do a 1031 exchange." For those that know, that's property exchanges that you can allow the deferral. A whole different conversation, or probably one we've already discussed. But here's the thing, Jason, right? She got on there and I said, "Well, have you, just to confirm, have you identified a qualified intermediary who to receive the funds?" She's like, "What's that?" And, simple thing was she didn't proactively go after the client. The client came to her. So she was able to go back to the client and said, "Hey, have you identified a qualified intermediary yet?" Which is the essential ingredient to make a 1031 continue to be a tax-free exchange or a tax roll-up overall. Because if we would not have had that one conversation, just happened to be a stroke of opportunity at the time, that client would have probably closed on their property, thought they were doing an exchange, and then realized later they lost 27 to 30% of that number. This particular deal, that's about $150,000 that they would have overpaid because they didn't get the right information from their realtor, who didn't even tell them about it. And we were able to uncover it because we understand our cut of meat and where we land on our cut of meat. And we do believe it's the best. But those are things we don't like to hear, the things that happen afterwards, because we can't fix it. That's all that I'm urging.
That advisor listens to us, Andy, on this. And I got a phone call from her, and she asked me a very similar thing about the 1031. I said, "Have you considered the qualified intermediary?" She starts laughing. She goes, "Did you and Andy talk about this?" And I was like, "No, why?" She goes, "I was just off the phone with Andy." I was like, "So why are you calling me?" She was like, "I just figured two heads are better than one, and a cord of three can't be quickly broken." And this is
she's just checking up on me.
I think it was that, and then also she owed me a phone call back on another topic. But what I'm getting at is, think about like the power of working within a team and having those resources available, so that not only are we able to find the information, but have credibility in the answers we give. And let's move on to distributions during a volatile market, because Andy, we got 5 minutes, brother. So we can keep it within 20 minutes. It can't be 22 minutes of clarity today. So let's keep it within the next couple minutes.
Yeah. Well, and I mean, Jason, this is more up your wheelhouse. I mean, you've got all the credentials. You've taken all the extra, training and commitment to helping clients make these decisions. So I'm really eager to talk to you. But the only thing I'll preview it up is like, how do you help clients better understand the impact of lost wealth when they're taking, possibly excess distributions, and then the impact of a drawdown market overall? I mean, just how do you help clients just kind of navigate through that understanding?
Well, it's proactive communication and understanding. There's essential risks that you take into going into distribution planning, and one of those risks would be what's called sequence of return risk. So if you experience poor market returns in like the early years of retirement, it can have a long-lasting negative impact on your portfolio's ability to sustain withdrawals over the long term. So it's really important during those retirement red zone years. I'm talking like 3 to 5 years before retirement and the first 5 years after retirement. And typically that 10-year period of time is absolutely the most crucial periods of time when it comes into distribution strategy and priming the pump, so to speak, preparing the portfolio for distributions to come out and managing the overall risk. And it's a very difficult time, not just for most advisors. They have a very hard time with this period of time, but also clients. And the reason why clients do is because their whole entire career, while they're working and saving money, it's always about building that money up. It's always been about the accumulation. Market pulls back like it did in 08, 12, 15, 18, 20, 2022. Okay, market pulls back. They're putting money in. They're buying more shares at a lower price point. They look like geniuses, right? They feel good about it. You reverse that. You retired in like 2007, and you did not adjust your portfolio to navigate volatility. And you just had to lean into those high-tech stocks that made all the money in the late 90s, feeling good about it and all that other stuff. Boom. Market comes in, rude awakening. You get betrayed by the market, and with that betrayal, it changes your entire financial future, where you would have to make lower withdrawals or even consider going back into work, right? And you may be forced to do something that you don't want to do because you didn't do something proactively. And like, okay, if I did something proactively, maybe I gave some upside return in order to secure my financial future. Is that worth it to you? And if not, then are you okay with making a knee-jerk reaction and doing something that you're forced to do? Most people will choose, no, I'm going to make the proactive decision. I will give up some of the upside to make sure that I can still retire on my terms, on my timeline, doing the things that I want to do throughout retirement. So sequence of return risk is what I just talked about. This is where I went into more of those details. This is where you can learn more. But like, it's just, we have plenty of content on sequence of return risk and other podcasts. This is where we want you to hit subscribe. Go back and see the other podcasts talking about this topic. It's such an important thing. But it's really going in like, you're withdrawing money in a down market, right? To break even. You can't just break even on the returns. You got to break even and then some, because you're accounting for the withdrawals as well. So like if the market pulls back, like let's say the market pulls back 10%. That's not a big pullback. Fair, right?
Yeah, that's normal today.
Normal today. I mean, yeah, you could get that in a couple months, right? With the volatility of this environment. But like to break even is not a 10% rate of return. No, you still fall short of breaking even. You're going to have to get like a 12, 13% rate of return. Now extrapolate that you went down 10% and you're doing a 5% withdrawal rate. The next year, you're not going to say to most financial advisors, hey, the market went down last year. I'm going to take less of my withdrawals. No, and like what we were in the last couple of years, you're going to say, I need more money. I need more money because of inflation and things went higher. I can't take a pay cut. I need more, right? So now you're taking a higher withdrawal on an account balance that went down in value.
Yeah.
Go figure, right? So making sure you have proper strategies in place to account for the what ifs. Hey, what if the market has a major market pullback? What arrows do we have in the quiver that we could use so that you're not selling these investments in a down market, so you're able to rebound faster because you're not also compounding the problem by making extra distributions?
Yeah, no, I think it's so important to hit that. And I'll probably say, Jason, we're probably going to have just a little bit of bonus content because I think this topic is so important. We probably will have a follow-up. But, we've hit our 20 minutes of clarity mark right now. but we're going to get bonus content for those that are still interested, because I do think there's some closing out points that I think are important, right? As well, because one, understanding what you just said, Jason, right? Is okay, what is the right number to take out, right? Why I wanted to continue some bonus content time is that also looking at and preparing ahead of time to what buckets to pull from, right? So how often do you kind of look at a client's buckets, meaning what is tax deferred, what is tax free, what is taxable, and understanding how are we going to take that money out? Because I know a lot of clients, Jason, they're not going to tell me that when they've hit the retirement button, no matter what the markets do, they're not going to be like, yeah, I'm going to take a little less this year. They've set their living expenses, right? So how do you kind of incorporate or kind of share maybe in a quick sentence, why is it important to understand the different buckets when you're considering making proactive distributions versus just assuming all out of one bucket?
I love that you talked about the buckets as far as the tax buckets, like how the withdrawals can impact the taxes, because that's such an important topic. It ties in what we talked about in the beginning. But another bucket approach would be, okay, segment your retirement assets into different buckets based off of time frame. Mm-hmm. So you have your short-term bucket or your income bucket. That's more lower risk, and this could be used for expenses in the next few years. Then you can have, like, inside that same income bucket, you could have like a midterm aspect. They'll contain like certain bonds or other income generating assets. So that would be like your income bucket, right? And then in the growth bucket, well, that's where you hold your equities for growth and more aggressive investments. So then when the growth bucket pulls back, you have the income bucket providing the income. You're not selling down those investments too soon. And then you can replenish the income bucket once the growth bucket has replenished itself and it's grown. Then you can use that to replenish it up. Typically, rule of thumb for income buckets, you want it no more than 5 years and no less than 2 years of income set aside. Now, when I go into income, I'm talking about, for those in retirement, I'm talking about your expenses once again, your expenses, okay? It's like, how much money are you spending per month, right, per year, and extrapolating that out 2 to 5 years. Now, the money that you're spending in the 1 year and maybe even next year, in the first 2 years, you're going to want to do like very conservative cash alternative type of approaches. This is all through the retirement income certified professional designation, right? Andy, you alluded to like my certifications. I'm just reminding people, you know, like, it's not just I have a CFP, a certified financial planner. It's also I'm a RICP. And I found out, Andy, only 1.3% of all the CFPs reside in South Carolina. Now, you've always said I'm a rare bird, right? But like, my goodness gracious, those 2 certifications with that experience and that knowledge that is required to be like, there's no numbers, there's no data of the 1.3% of the CFPs in South Carolina, how many of them also are retirement income certified professionals. Right. So when we're going into this, I hope everyone that's listening and watching, they're seeing that we're taking complex information and we're simplifying it to the best of our ability, so that those that are investing into their financial future, they could take this and make actionable things if they decide to keep on doing it on their own. They could call their advisor saying, hey, can you do this for me? And then they could call us afterwards when they don't hear the answer they want to hear. Right? Yeah. Or they could just go on to Clear Picture Financial, check out other content we have, scroll down, they can enter their information. And Andy, this is what I want them to do. I want them to type in 20 minutes. They type in 20 minutes into the comment section there, along with anything else they want to know. Now we know that we're going to be able to waive that initial consultation fee because they have taken the time not only to watch and listen, but they've also taken the time to take that step and start putting a plan in place for their financial future.
No, I think that's such a great action plan, and I appreciate those. And this bonus feature, I think it's important, right? So I hope everybody that's listening and tuning in today will take us up on that 20 minutes of clarity offer. I'm telling you, you get one shot at a real good plan. The redo's hard. So if you're listening today and you don't want to lose wealth to overpaying taxes or other unnecessary expenses, if you want to be more proactive in your income strategy, and if you want to understand more of the why and the how, and not just the what that you have to go solve so you can have peace of mind, give us a call. You heard it right there. You've got Jason Noble, who's a very rare bird, who's going to sit there and help us to make sure those distribution things. We both don't like to incorporate the government any more than we have to. So we hope to hear from you soon, and just simplify your relationship with your wealth. So until next, that was 20 minutes of clarity.